what exactly is 1031 exchange and how does it benefit the real estate investors?
Yeah, no. So IRS code 1031 has been around for 100 years. It's one of the oldest tax codes and arguably the most powerful of the tax codes as it pertains to investment property owners. And essentially it allows investment property owners to defer paying taxes on the sale of their investment property as long as they buy replacement property with the proceeds from sale, right? So you own investment property, you sell it, as long as you take the proceeds from sale and reinvest into investment property, you can defer taxes. And the saying, or one of the sayings, is you can swap till you drop. So, you can continue to exchange until you pass away, at which point the taxes that you've deferred over 20, 30, 50 years go away.
This is a Real Estate Vibe Show, and I'm your host, Vinki Loomba. As a real estate investor and a fund manager, I'm always excited to explore the world of real estate opportunities with you and for you. Today, I have Benjamin Carmona with me, and I think you go by Ben, right, Ben?
Yes.
So welcome, Ben, to the Real Estate Vibe Show.
Thank you so much. It's great to be here, Vinki.
So a little bit about Ben. Ben is a seasoned expert in 1031 exchanges, Delaware Statutory Trusts, DSTs, and real estate investment strategies with over 20 years of experience. Having worked with many top firms, he specializes in acquisitions, finance, and structured investment products. His deep expertise in alternative investments make him a trusted advisor for clients seeking strategic tax-efficient wealth building solutions. So today we'll be discussing maximizing wealth with 1031 exchanges, DSTs, and structured real estate investments. So leveraging 1031 exchanges, DSTs, and structured real estate investment is a powerful way to defer taxes, diversify portfolios, and build long-term wealth. These strategies allow investors to preserve wealth, generate passive income, and optimize their real estate holdings without the burden of active management. So remember what I said, active management. So this is all passive that we're going to be talking. By understanding and utilizing these tools effectively, investors can maximize returns, reduce tax liabilities, and create a sustainable path to generational wealth. So first we wanted to understand what exactly 1031 exchange is and why it mattered. So Ben, I'm going to come ask you this.
So, you can continue to exchange until you pass away, at which point the taxes that you've deferred over 20, 30, 50 years go away, right? Which is incredibly powerful. It's the reason why so many wealthy, affluent folks invest in real estate. So again, you can sell and you buy a property for $1 million, you sell it for $3 million after 3 years, you buy another property for $3 million, and it goes to 7 million, and on and on and on throughout the generations. And then when you pass, your kids can inherit these assets at a stepped up cost basis.
So let's talk about that a little bit more in depth. How does a 1031 exchange help defer capital gain taxes and building long-term wealth? And then the other question was coming to my mind when you were talking is, if you just keep on deferring, and then heirs are using, is when do you get to use portion of it?
Yeah, that's why it's good and bad news, right? You swap until you drop. It's good for the beneficiaries, not necessarily for you. Okay, so the front end, you said the taxes. What kind of taxes are? So again, I mean, we're both in California. Mm-hmm. So if you're subject to, when you sell an investment property, you're subject to 4 buckets of taxes. You have the Fed taxes, which up to 20%. The state level taxes, unfortunately for Vinki and we're subject to 13.3%. Mm-hmm. Then you have what's referred to as net investment income tax of 3.8%. And then you have depreciation recapture tax at 25%, right? And depreciation, when you own investment property, you're able to depreciate those assets over time to help shelter income. And if you sell and you don't do an exchange, all these, you're subject to all four of these buckets, depending on what tax bracket you're in. In the interest of time, I won't go into too much, but does that answer your question on that front, Vinki?
Yes, it does. So, but the thing is, it's like quite a bit of savings up front when you're doing 1031. Basically, whatever equity you got in the first property, you're just moving into the next one, 100%, right? As is. Or is there some percentage can you hold back for yourself without paying any taxes?
No, it's you know, you either do the exchange or you can do a partial exchange, right? Let's just say, you know, you own a property for whatever, how many years it's appreciated, you do an exchange and you can defer all the taxes, you know, all across those four buckets. Or you may say, hey, I'm going to take a little bit of cash out and you'll pay tax on that boot, if you will, it's referred to, and you can defer the rest. But the power in it, and this is, I'm just making up this example. If you bought a property for $1 million and in 5 years or 10 years, whatever, it's $3 million. If you do an exchange, you're going to preserve that 3 million, the full 3 million to reinvest. Or if you cash out, and again, there's no numbers behind this, but I'm just making it up, you may only come out with 1.3 million, or excuse me, 2.3 million. Right? So you either keep the 3 million intact working for you, or you pay the taxes and walk away with 2.3 million in equity. You know, that's 700,000. That's a big hit. And over time, that 700,000 can equate to significant wealth.
When you say partial deferment, is there something also that you can do is diversify? You can take portion of it, do 1031, and then maybe take portion of it, go to DST. That's the next question I'm going to ask you, and we'll go through that, what DST is. We start from the bare basics. But at this point, can you shed some light on that? Because can you do some kind of diversification and not putting everything in one asset or next asset?
Yeah, for sure. You can. There are different investment structures or vehicles that you can utilize to diversify. Of course, it's dependent upon the asset, you know, how much equity you have, right? If you're going to do a direct exchange, right, just you sell your investment property, you buy another investment property, and that's 90% of all exchanges today. Look, if you have the means or the capital, yeah, you could split it up as many ways as you want. But, you know, like us for California, if you sell a $2.5 million property, chances are you're not going to be able to buy more than one property in California, right? But yes, the short answer is there are diversification avenues to consider.
You can do that. And then you have to work with some particular person to do that. How does that work? Is there like a 1031 or DST companies out there who help you diversify? I mean, because the way I know is please excuse me for my minimum knowledge. The way I understand is, you know, when you're doing 1031 exchange, you have to buy the next property for the similar value or more value. Correct. So you can deploy all your equity or whatever profits are into the next property. That way you're not paying any taxes. But if you, let's say if you wanted to diversify, somebody made $2 million and he thinks, okay, I don't want to put the whole $2 million into the next property, but I wanted to maybe take and I wanted to invest in DST too, like million here, million here. So are there any particular agencies or any particular people that people can work with, you know, like financial planners, somebody like out there?
Absolutely. And before I touch on that, we didn't touch on the 1031 exchange rules. You know, and I won't go into too much detail, but the IRS has blessed us with this opportunity to defer taxes, right? But they don't make it easy. So it's not like an easy process. There's time restrictions. To your point, you need to buy equal to, if not more, real estate, match the debt, so on and so forth. So as it pertains to, you know, working with folks, yes, in my world, in the offerings that I recommend or specialize in, you have to work with a financial advisor or professional, right? You have to have securities license to manage these. But then also you do your own syndications on the direct real estate side. right? And there's lots of syndications, both on the real estate securities end, which is where I am, and also on the direct real estate. But unless you have the time, the wherewithal, the expertise to find the suitable investment or replacement property, it's always a good idea to work with a professional like yourself or my team to help.
Thank you. Thank you for answering that, because I thought this is important for people to know, to work with a professional versus trying to do on their own. And the next question is related to that. I wanted to ask you, what are some of the common mistakes investors make when they're doing a 1031 exchange? Because I know there's a time limit, right? 40 days or something like that to identify the property. I think most of the people know that. But beside that, what are some of the major pitfalls that they can avoid?
Okay. So, well, you'd be surprised. Many investors have heard of 1031 exchanges, but they're not really all that familiar with them.
Mm-hmm.
Furthermore, that applies to a lot of attorneys and CPAs, believe it or not.
Mm-hmm.
They know of them, but if they don't focus on them, they're not in tune. And so I can't tell you how many times I'm working with the client, and no disrespect to their professional, but I catch them, no, this is not the right advice, right? Sometimes they say, hey, you can take your basis out and just exchange the balance. No. And so that would be, I guess, a precautionary is, make sure your professional is advising you appropriately, whether that be an advisor, a CPA, an attorney, because a lot of folks just aren't familiar with real estate and the 1031 exchanges. In my world, I would say one of the biggest mistakes, and it's the reason why I do what I do, is investors get wrapped up or sold by the wrong investor or excuse me, advisor or professional. There's a lot of, they're chasing yield, right? They're getting excited or being sold an attractive offering, but not really understanding the underlying risks, right? That would be my biggest caution to investors today.
Yeah, don't rush, right? Take your time. I mean, if you think you're going to get out of a property 6 months before, a year before, start planning what is next for you before you exit, plan your exit. That's a safer way of doing things. So let's move on to the DST now. Yeah. So what exactly DST is? And I know it's like a good term. I think there's multiple meanings to this. Delaware Statutory Trust, and there's something else too that meant DST as well, right? So not to confuse the two. So today we're going to be talking about the Delaware Statutory Trust, the DST, where you can invest your money. So if you can tell us what is it and how people can invest.
Absolutely. So Delaware Statutory Trust, I'm going to start with just giving you a background on it. And then I'll describe an example. Mm-hmm. So DSTs, or Delaware Statutory Trusts, they were created in the 80s. Mm-hmm. It's a trust, it's an entity. And they weren't set up for 1031 exchange purposes at that time, but it's a trust whereby you have one trustee that manages the trust on behalf of up to 499 beneficial owners, right? So it's fractionalized ownership. So when you apply this trust to real estate, it creates a situation where you can have a lot of up to 499 investors buy into this trust and own an undivided interest in real property, right? In 2004, the IRS came out and validated this fractionalized ownership structure as real property ownership, and therefore eligible to satisfy exchanges, right? Okay, so what does that all mean? So I'll tell you, in this world, I'll refer to them as sponsors or syndicators. And broadly speaking, these are big real estate firms, institutions, whether it be Cantor Fitzgerald or Jones Lang LaSalle or Ares, Apollo. I mean, these are big folk, big organizations. They go out and they use their relationships and expertise and capital to buy big institutional properties. It could be a $100 million multifamily in Dallas, Texas. It could be a $50 million self-storage portfolio in Raleigh, North Carolina. It could be a medical office campus in Orlando, Florida, right? So you have these big sponsors. They go out and buy the real estate. They secure debt on some of them. Some of them are debt-free, but these properties are obviously owned, stabilized, income producing. And what these sponsors do is they provide the asset management, right? So they're running the asset or managing the asset. They secure property management. They pay out monthly distributions. They provide quarterly operating reports, performance reports. They provide end-of-year tax returns. So these are turnkey 1031 exchange replacement property solutions, right? So they buy these, they get them all ready, and they turn around and they offer them to retail investors like you or I. And so again, we didn't get into the challenges or limitations that the IRS sets forth to complete an exchange. But if you or I sell a property tomorrow, maybe we have replacement property already lined up, maybe we don't. Maybe we don't want to manage anymore, right? And this is really where the DSTs cater to. You can take your proceeds from sale and exchange directly into these properties, and you can do it quickly, swiftly. In 1 week, you can be invested. Your income's accruing immediately. You get paid out monthly distributions, and you fly off into the sunset. I'm going to say one other thing on this front is, in the spirit of diversification, right? You brought that up. Because you're allowed so many investors in a DST, the minimums are low, typically between 100 to 250,000. So I always give this example. If I'm working with little Mrs. Smith, who's 80 years old, and she's selling a duplex or a triplex, and she doesn't know what to do. She doesn't want to manage real estate. And so I could take her proceeds from sale and I could help her really mitigate risk through diversification. I may put 250,000 into the medical office building, 250,000 into the multifamily, 250,000 into oil, mineral rights. I can build a customized, diversified portfolio for my clients that, again, mitigates risk, more times than not increases their income, defers their taxes, of course. And so it's a very powerful structure. Last thing I promised, then I'll stop. I'm sure you have more questions. I want to just, before I forget, the downside to DSTs, right, is that these are illiquid investments. So if you go into them, there's no just getting out. There's no formal secondary market available to you if you needed the liquidity. So you're giving up you're giving up control and putting your full faith and trust into these sponsor companies to manage that real estate on your behalf. And folks like me help determine or recommend the best offerings relative to the client's objectives and suitability.
Great. Oh my God, that's a lot of information. You gave so much in one shot. I have so many follow-up questions. So let's start with first the being illiquid, right? So what is the time frame? Is there a time frame for any DST? Like for the syndication, I'm going to go there as well in a second, but in a syndication, usually there's a timeline, 5 years, 7 years, 10 years, 15 years, right? When people are syndicating the projects. So is there any timeline for a DST when it's going to mature? And what happens when it matures? Great question.
So just like most syndications, look, there's always a strategy in place on the front end, right? Oh, we're going to buy this, we're going to renovate, rehab, and then we're going to sell. That may be a 2 to 4 year or 5 to 7 year. The DSTs, by and large, broadly speaking, are 5 to 7 year hold. It could be sooner, it could be later. So when the DST matures, right, you buy in, 5 years later, they go to sell it. And it may be, hey, communication from the sponsor investors. We received an unsolicited offer from XYZ. It's a great deal. We're going to take it. We're going to close in 3 months or 60 days. And so you close. And so at that point, you take the proceeds from sale and all options are back on the table. Maybe you love the DSTs, like, well, this is fantastic, I'm gonna go back in. Or maybe, you know, you want to buy an investment property eventually to go to your, you know, children, you know, buy direct. You can do that, or you can cash out and pay taxes. So DSTs, and this is a misconception, it's not the last stop. You have options when they sell.
When you exit. Okay. So let me ask you this question. So DST, you said, is usually you have a cash flowing deals. We'll go there too in a second, but you have mostly cash flow. It's a turnkey projects, right? So it's not like heavy lift that you start from ground zero and somebody has to wait on the distributions. So distribution is going to start right away. So what does the DST structure look like from an investor's perspective, right? You plug into the deal, do you start getting your monthly distributions? And then you get something at the exit as well, like portion of the equity?
Yeah. So I'll say, so when you invest in a DST, you're buying into, you're an undivided owner, undivided fractionalized owner in this trust. So just an example, it's a $100 million deal. You invest $1 million. You're a 1% undivided owner of the trust that owns the underlying real estate. You're entitled to 1% of the income, the expenses, the depreciation, and appreciation upon sale. So, you know, so on the back end, when they sell, hopefully, right, there's appreciation. So in that deal, if you put in $1 million, if it sells in 5 years for 120 million, right, you're going to get your $1 million back plus 1% of the profits of the 20 million. That would be $200,000, right? So you get your pro rata share of the profits on the back end.
On the back end. So let me ask you this question. How does DST differ than syndication? Because syndication is kind of the similar structure too, if I'm understanding it correctly. So if you can tell us the difference between the two and why would somebody prefer DST over syndication or vice versa?
Sure, absolutely. So the DSTs, and I guess they're all syndications, it's just the direct real estate side versus the securities. The capital sponsors, the difference is anybody that's raising capital through the independent broker dealer or registered advisor channel, right? Financial advisors, they have to be securities, right? I mean, we're licensed. And so, but the syndications are, I mean, depending what you're comparing to, a syndication is a syndication. I guess the benefit of the DSTs or any of these syndications are the lower minimums, I would say. I'd also say that many of our offerings, or all of our offerings, the debt is non-recourse, right? So if you need debt to satisfy your exchange, the sponsors secure the debt, they're liable for it, our investors are not. And so investors can just walk right into the debt. They don't have to get pre-approved by the bank. It's not a liability on their balance sheet. And I would also say, to some extent, and this isn't just the amount of due diligence and compliance and legal that is involved on our side of the business, given it is securities, that's different. But on the flip side, by and large, private syndications, if you find a good operator, right, like yourself, the fees are going to be less than what an offering that I have to provide, right? Because think about it, you, Vinki, can build your deal and bring investors. In this world, the sponsors are bringing the deals, putting them together, bringing them to this market. They have to do legal and marketing and underwriting and syndication costs, and then they have to pay us, the advisors and the broker dealers. I know this is a lot, but they're more expensive on my end than they are on the private side.
Yeah, private side is going to be a little bit less. And plus, it's going to be maybe a little bit smaller deal because the bigger deals in the syndication as well, they might not let you 1031 either, because we're just talking about the 1031 and the DSTs. Just for the context of it, I wanted to make sure that everybody is on the same page.
Yeah,
So
Vinki,
the next question.
Just
go
real
ahead.
quick, I'm sorry. You have to be an accredited investor to even invest in our deal. So you have to have $1 million net worth excluding your personal residence.
I wanted to ask you, you've been using the terminology fractional owner. So in DST, is it like you are fractional owner? What does that equates to? Is it like a shares like we do the shares in the syndication? That's how you are a shareholder in that particular LLC or trust?
It actually is, well, it's kind of what I just described about the $100 million example. You're a 1% undivided owner in the real estate. And the difference being, like, you can invest in a syndication, an LP, where you own shares of a larger product. You're not a direct owner. In the DST world or other vehicles that we work with, you're a direct owner of the property. And so you have, you're a 1% or 5% or 15%, owner. That answered the question.
Yeah, okay, that's good. So let's move on to our the structured real estate options, So there's multiple ways to do things beyond DSTs or 1031s. There's another structures like TIC structure or REIT or private equity. How does that compare to DST investments? Any light that you can shed there?
Yeah, so I'll just take 1 minute on my background. So I've been in this space, as you said, for almost 15 years. 4 years ago, I started advising clients with their investments and recommending. Prior to that 15 years, I spent on the real estate investment, syndication side, the sponsor side of the business, right? So I was involved in buying the real estate, underwriting, due diligence, training and educating advisors like myself and attorneys and CPAs nationwide. And so, and I was structuring all sorts of deals, whether it be private REITs or business development companies, BDCs, funds, DSTs, TICs. So I have a very good understanding of how the cooking is made, if you will, not only with the exchange products, but also the other private syndications where investors may say, hey, look, I'm over allocated in stocks and bonds and mutual funds and annuities, right? How else can I diversify? Right? And they could invest with you, right? Or they can invest through our offerings. And broadly speaking, they're referred to alternative investments. And I'm going to tell this story really quick, but it's powerful. You go back to 2008 and the world blew up, right? And the folks that did every single thing right, they saved money, they built these stock and bond portfolios, 60-40 plus cash, they had real estate. The folks that did everything right still got crushed in that debacle. And so you look around and you say, okay, well, who didn't get beat up? And it was the institutions, it was the endowments, the big boys. And okay, well, why didn't they get beat up? What were they investing in? Well, they were investing in alternative investments. And so those investments that are not exchange traded, right, on funds, they're just in private equity or private real estate funds that are stable, predictable, defensive in nature. So the income was continuing. And so that is, really the passion behind what I and our broader team brings to the table is now everybody has come back, right? Since 2008, everybody's come back and they're thinking, what can I do to prevent another 2008, right? There's still a lot of uncertainty in the markets. And so taking advantage of these private syndications or the exchange products can be a very powerful way to mitigate that risk and preserve wealth, and come through positively. God forbid we hit some choppy times.
Great. So when you're talking about the choppy times, I'm going to ask you one regulatory question as well. Are there any regulatory changes or tax law updates that could impact 1031 exchanges or DSTs in this environment?
They always, right? You're always subject to changes. They've been under threat for many, many years in a row with the Trump administration. I don't think there's going to be any adjustments. And frankly, whatever aisle you sit on, so many folks own real estate and they love the 1031. So I don't foresee anything happening, but you don't know what you don't know, right?
That's true. So, but what do you see in your crystal ball, the future of these 1031s or DSTs? What's going to happen?
Yeah, look, I think DSTs, and again, I've been in the business 2 years. I started 2 years after they were actually validated. And I've
Mhm.
seen the industry grow, and I believe wholeheartedly it will continue to grow. And it's a function of demographics, right? Most of the wealth in our country is controlled by the baby boomers and seniors. And a lot of that wealth is in private real estate that they've owned and managed for 20, 30, 50 years. They don't want to actively manage anymore. They're earning very little income relative to what the value of the property is today. Most cases, 1 to 3%. They've held it for a long time, so they're fully depreciated. They have no cost basis. And they're hoping and dreaming and praying of a solution that will allow them to the freedom, right? To get out of active management, defer the taxes, get the stable, predictable income so that they can spend more time with their families and do what they want to do. So regardless of where real estate goes, assuming the 1031 doesn't get tossed, which I don't think it ever will, DSTs and these structured products are going to continue to accelerate in growth over time.
Great. So I forgot to ask you one question. You mentioned DST structured of 500 people, I would say 500 investors, one being the operator or the sponsor, the lead person who's leading the DST. So how does somebody decide that this person's going to be sponsor? Like, is the sponsor person responsible for finding the deals, just like in regular syndications and bringing the deal together, bringing the investors together? Or is there any licensing needed? Or what exactly that structure look like, if you
Yeah.
can shed some light?
Yeah. So, anybody can be just a direct real estate syndicator, right?
Uh-huh.
Anybody. Not
Right.
in our world. Like, again, in order to even there are so many prerequisites that need to happen prior to the industry, the advisor community embracing a sponsor. So it's very difficult to penetrate this space.
Mhm.
Um, and so there needs to be sponsor reports, right? Like they need to provide a background on each one of the officers that are part of the syndication or the sponsor. They need to provide legal backgrounds, tax. There's a tremendous amount that is required to get into the space. Um, and so, no, it's not easy. And for most sponsors that do come into the space, it takes time for them to build their reputation, right? But the reason you see the landscape has changed so much. All these institutions are coming down into the retail space, which is an anomaly, right? You think, why are these folks coming here? And the reason is the pension fund money, those went away. It's dried up. That's where these folks used to get money from. Where the biggest opportunity to raise capital is in the space that we're working with, right? The retail channel. And
Mhm.
so that's why they're coming down to this to space, because of all our collective investors that are in a position, are looking to retire and incorporate alternative investments into their mix.
Great. So I think we are almost at time, or maybe over time a little bit. So one last thing that you wanted to share with my audience as a golden nugget, one key takeaway on DSTs or 1031s.
One key tip. If you own investment property, just reach out to a professional and to learn about them. Right, it's so important. Many cases, it does not make sense to pay the tax, and of course, we're happy to help there. But I encourage you to reach out to a professional to learn about them.
Thank you so much for saying that. So this brings us to our rapid fire round. I'm going to ask you 5 questions. You have to answer it in 1 word or 1 sentence only. Are you ready?
I hope so.
I'm building the momentum right there.
Yeah.
What is one of the most important thing you have learned in your life, and how did your life change after learning it?
Oh my gosh, rapid fire. What is the most important thing I've learned in my life? Um, Trust in God.
I like that. Trust the process. You're gonna
Trust
get
the
there no matter
process.
what. I love that. Share one good book that you would like to recommend to my audience.
I knew you were going to say that. I do not. I'm not a big book reader. Look, this is so cliche. I don't read. I'm talking to so many professionals all day long. I know this is supposed to be one word. Rich Dad Poor Dad. It's great.
Oh, thank you. Everybody
I
says
love
that.
it. Oh, they do?
Usually my question is beside rich dad poor dad. I'm like, oh, that's okay. We'll take that. In one word, what does life mean to you?
Blessing?
Yeah, you're so right. Life is a blessing. I love that answer. What is your biggest passion?
My biggest passion?
Mhm.
Well, I mean, other than my family, pickleball. I love pickleball.
That's good. That's good. If you could turn back in time and talk to your younger self, what would you tell yourself and why?
Um, I would say I should have trust your instincts, and I wish I would have gone out on my own earlier, frankly.
I like that answer, actually. That's what a lot of people say that, because we didn't trust the process, we didn't believe in ourselves. That's a really good answer. Thanks for sharing that. And if you can share with us, how can people reach out to you?
Absolutely. I'll give you my cell phone and my email. Our website is perchwealth.com, PERCH wealth.com. My cell phone is 818-269-4972, 818-269-4972. And my email is bcarmona, CARMONA @perchwealth.com. We have 11 advisors on our team. I have a business partner. We're all over the country. So we'd love to hear from you and look forward to it. Thank you so much.
Thank you so much, Ben, for being on my show. I really appreciate that.
Absolutely. I look forward to talking to you soon.
Thank you, everyone, for tuning in to the Real Estate Vibe Show. Don't forget to subscribe, leave a review, and share this episode with anyone looking to elevate their real estate investing game. Until next time, stay focused, stay inspired, and keep building your real estate vibe. Thanks again.